Good afternoon, Patrick Dwyer and Greg Pool, and we are here today to talk about the ChatGPT moment in wealth management. In November 2022, OpenAI launched ChatGPT, and within 2 months, it had about 100 million users. Incredible. It wasn't just the fastest growing product in history, it was a signal, a moment where the entire industry's assumptions about what has access to sophisticated tools got destroyed overnight.
Yeah. I mean, doctors assumed patients couldn't interpret their own lab results. Teachers had assumed research required an expert. Lawyers had assumed drafting contracts was unreachable for non-lawyers. And in every case, ChatGPT really showed that the gap between expert and the non-expert had very quietly and quickly closed.
Yeah. I mean, wealth management is next up. And in some ways, it's the industry that had the most to lose because it was built most deliberately on information asymmetry than almost any other business.
And that's what this video is about. We want to walk through a model that has been in place for decades and why it's breaking down, what AI is actually going to do to it, and what it means for you, whether you're a current client or someone wondering, why your advisor relationship has always felt somewhat opaque.
Yeah, we'll start with the model itself, but understand that the net outcome of this is good for the consumer. It's good, really good for them, I think. It's excellent. So the traditional wealth management model has 3 structural features that really matter, and 0 of them are accidents.
Yeah. The first is the information gap. So for most clients, the stated advisory fee, it's the only visible cost. It's what we hear clients saying their fee is the most. It looks clear, but underneath that advisory fee, there are fund expense ratios, trading costs, revenue sharing arrangements between the advisor and the fund companies on the platform, and in many cases, share class arbitrage, where the advisor puts you in the version of a fund that pays them a distribution fee rather than the cheapest share class, which is best for you.
Yeah, and I want to be direct about this. Clients are not told about most of these costs. They're not. The advisor knows, the firm knows, you don't know. That's not an oversight. That is the business model.
And that second feature is product conflict. So, at the big wirehouses, and it's all of them, Merrill Lynch, Morgan Stanley, Wells Fargo, UBS, advisors they have fiduciary responsibility to the firm, not to you. And they operate under the suitability standard, which means they only need to recommend something that isn't obviously wrong for your situation. And not the best thing, not the lowest cost thing, just not obviously wrong.
Yeah, and that matters more than most people realize because it means that an advisor puts you in an expensive mutual fund that will underperform a low-cost index. They haven't violated an obligation, by the way. They've just operated within the standard that they're being held to.
Yeah. And then the third feature, it's switching friction. So the big banks operate in an environment where they spend enormous resources on custody integration. So they tangle your lending, your trusts, your brokerage, your estate documents into one web so that leaving feels operationally difficult, because it is. And the goal there is retention. It's not service.
Right. I mean, your advisor works for their firm. We like to say we work for you. And for decades, this entanglement model worked. I did it at Bank of America because the client had no efficient way to audit what was actually happening. They couldn't easily compare their fund performance to a benchmark. They couldn't calculate the all-in fee. They didn't know that the same index fund came in a dozen different share classes at a dozen different price points. The information asymmetry was the product, and AI is dismantling it.
Yeah, quickly. So let's talk about the collapse of the information gap. So here's the number that should get every traditional advisor's attention. Nearly a third of U.S. consumers are already using AI tools to analyze their financial situation. And that's not 5 years, that's today.
Yeah, and what does that actually mean in practice? It means that you can take your brokerage statement, drop it into, take one with 4 columns and a lot of fund names you've never heard of, put it into ChatGPT and say, what am I paying? You can basically ask ChatGPT all the uncomfortable questions that you don't want to ask the advisor that you like personally, right? And, you're going to get the answers.
Yeah, it will tell you, it will identify the fund expense ratios. It will calculate the all-in cost, compare your holdings to the index components. It'll flag if you're in a more expensive share class of a fund that exists in a cheaper version. Basically, in 90 seconds, the client can know more about their account than the advisor has ever volunteered.
Yeah. And I like to tell people, ask what the probability of those products outperforming a benchmark is. It'll give you the odds. And you'll be like, why did my financial advisor put me in something that has only a 20% chance of outperforming after taxes and fees? It's a good question. It's probably because it was good for him. And that changes the conversation completely when clients have this information, right? Because the model that depends on clients not knowing what they're paying only works when clients don't know what they're paying.
Yeah. And, I think there's one comparison that puts this in helpful context. So before ChatGPT, actually before the internet, really, the information asymmetry in medicine was just as entrenched. Your doctor had knowledge that you didn't have access to. You couldn't look up your diagnosis, your treatment options, the side effects of your medication. You really trusted because you had no alternative.
Yeah. And then WebMD happened, and then PubMD became public medical information became searchable, and then AI came along, and patients started arriving at appointments with printed research and second opinions, and doctors had to adapt, not because patients were smarter, but because patients closed that information gap and suddenly could ask the right questions. And the same thing's happening in wealth management.
Yeah, and the families that see this and understand it are going to be in the best position to act on it.
That's right. Let's put numbers to this because the math is where it gets real.
Yeah, so the typical wirehouse setup looks like this. So the advisory fee is often around 1%. That's the visible fee, the one you see in the statement. And underneath that, active mutual funds they've selected have an average expense ratio of about 75 basis points. I mean, you don't see this in your statement. It comes out of the fund's performance before that number is reported to you.
So even before we've touched the tax efficiency question, you've already at 175, and that's the floor. And many clients have revenue sharing arrangements built into the funds, and additional layers and so forth. It's kind of crazy.
And then you want to add on top of that the tax drag. So, for managers that use active funds, they are trading constantly within the fund itself, and that generates frequently short-term capital gains distributions, which are taxed at your ordinary rate, not at your capital gains rate. And Morningstar research puts the average annual tax drag on an actively managed fund at around 1.8%, which is a big number.
So now you have the advisory fee of 1%, fund expenses, 75 basis points, tax drag of close to 2%. And you're a total headwind of roughly 3.5% against a gross market return every single year.
And let's compare that to what we do here at Align. So our advisory fee is 50 basis points. We never charge more than that. And we use direct indexing, which means we own the individual stocks, not the funds. Zero fund expense ratios on top of the advisory fee. And our tax drag is a fraction of the active model, closer to 30 basis points, because we're not generating unnecessary capital gains distributions, and we're actively harvesting losses to offset gains elsewhere.
Yeah, and just keep the math really simple. Like you compare this on a $5 million portfolio is roughly $17,500 a month, leaving your account under the traditional model versus about $400,000 under ours. And that's a gap of over $125,000 per year, the same thing.
Yeah, and it's not just those dollars today. It's what compounds over 20 years. So $125,000 a year compounding at the market return. I mean, that's not just a fee difference. That's a retirement difference. I mean, it's a generational difference.
Yeah, it's stark. So the S&P SPIVA scorecard, which is S&P's own research, comparing active fund managers to their benchmark, has been publishing consistent results over 20 years, and the numbers haven't changed.
Yeah. So over 20-year horizon, 95% of U.S. large cap active fund managers underperform the S&P 500. Not 60, not 75, 95%.
And your advisor's charging you to buy these active managers on top of it. So that further, reduces your odds of outperforming to like zero.
Yeah, to zero. And, you'll hear a response from traditional advisors, but international markets are less efficient. Active management works better in EM or in small cap and fixed income. Okay, it's worth unpacking that.
Yeah. And large cap equities, 95% fail over 20 years. In international developed markets, 87% fail. In emerging markets, 91% fail. International small cap, 95% fail. I mean, so, clearly what they're telling people is not true.
Yeah. In fixed income, it is genuinely different. So active managers in bonds do outperform their benchmarks with meaningful consistency. The ones that outperform continue to outperform. And that's particularly true in investment grade credit and municipal bonds. So the data does support having active management in fixed income. And so that's where we use it.
Yeah. We're not ideologically anti-active management. We just literally follow the data. So like tomorrow morning, if active management starts to work again and the data shows that, we'll go to active management. It's just in equities, the data says index. In fixed income, the data has said that active managers have a real material edge. and alternatives where manager selection truly matters. We're selective about where we access those strategies and how much we pay. But all things being equal, fees really matter.
They do. So let's talk about direct indexing specifically because it's become central to how the best wealth managers serve clients, and many investors haven't heard of it.
Yeah. I mean, so a traditional equity fund works like this. You buy a share of a fund and the fund manager holds a basket of stocks for you. When the stocks in the basket go up, the fund earns gains. When the manager sells something at a gain, those gains are distributed to you as a taxable event, whether you want the gain or not.
Yeah, so direct indexing will flip the structure. So instead of buying one single share of a fund, we buy the individual stocks that make up the index directly in your account. So instead of owning, one share of the S&P 500 fund, you own the underlying companies, Apple, Microsoft, Nvidia, Amazon, et cetera, 300 to 500 individual securities.
Yeah, and the key difference is control. When one of those positions is down, we can sell it, realize the tax loss, reinvest in a correlated position to maintain market exposure. So you sell Delta at a loss and you buy more American Airlines. So you're doing the same. And we use those tax losses to offset gains elsewhere in the portfolio. The IRS is your silent partner in the trade. You're converting market volatility into a tax asset. So like last year when we had the market sell-off at the beginning of the year, we booked about losses inside our direct index that finished the year plus 21%, in the neighborhood of about 2% of the value of the portfolio. So it was really meaningful tax alpha.
Yeah, and industry research, including Vanguard's own white papers and independent academic studies, puts the average annual tax alpha from systematic direct index harvesting between 50 and 150 basis points per year. So over a 20-year period, if you can compound that, that's a meaningful number. On a $10 million portfolio, that can be, millions of dollars of after-tax wealth that stays with you instead of going to the IRS.
And this is available at scale, not because of tech, right? It's because of technology, excuse me, because of tech. Running this strategy manually, which is what people used to do, was really difficult to do, and watch sales and so forth. And this is all being done by actually AI that we're using, and it's amazing. And you can customize your portfolio any way you want.
Yeah, I mean, it's sort of a useful irony. AI is making passive investing dramatically more powerful while simultaneously making active management that advisors have been charging for dramatically less defensible.
Yeah, and I want to spend a minute on something that is more, kind of interesting, and for many people is, what do we not sell? I want to spend a minute talking. It sounds simple, but I think it's important for you to say what isn't going to be shown to me.
Yeah. Well, let's go through our list and explain why. So I think one thing we don't do is structured notes. So these are, complex fixed income derivatives that wirehouses love. Often the fees and the margins are enormous, typically 4 to 8% embedded at issuance. The client sees a simple brochure with a protected principal and market linked return, and it looks attractive. But what they don't see is how much was extracted at the point of creation. We don't use these.
Yeah, we don't. I mean, we're happy to show clients our own portfolios if they want to see what's in our accounts. We don't buy any of this kind of stuff. We buy what we're recommending to you. We also, annuities, variable annuities in particular, these are often sold as tax advantage vehicles to people who are already in a tax advantage account or would be better served by a simple diversified portfolio. The commissions are huge, often 6 to 8% up front, and the surrender charges trap you in them for years with very, very high fees.
Active management in public equity markets. I mean, we've just rocked through this. We have the data, 95% underperform over 20 years. There's no justification for charging a client more to get worse outcomes. So we use index strategies in public equities.
We don't proprietary products. So we don't create any proprietary products, so we don't have any to sell. But it's just really important for anyone to understand that someone is going to have much more of a conflict to sell proprietary product because they're going to get their advisory fee and the underlying fee. And that is a conflict. You want your advisor to be neutral, to be picking what's best for you, not what's best for them.
Yeah, and the last is high fee alternative access layers. So this is big in the space. So the standard structure in private markets has been, the advisor charges 1%, the active manager, alternative manager charges say 2 and 20, and if you're accessing it through a feeder fund, you can add another 1% on top of that. So you're paying, this is 4% plus before you see $1 of return.
So ask your current advisor these questions, and you'll learn a lot. But you don't really have to ask your advisor because he's not going to probably tell you the truth anyway. But you can probably just go to ChatGPT and ask it all the questions. It'll even answer the questions about conflicts that the firm has, fee rescissions with products, and so forth.
So let's talk about, I guess, what we think wealth management is supposed to be versus what most clients are receiving.
Right. So at most firms, wealth management means portfolio management. You hand over your investments, your advisor builds a portfolio, charges you a fee, sends you a quarterly statement, and that's the service.
But for most families with, meaningful complexity, that could be significant assets, multiple entities, business, concentrated stock, real estate, charitable goals, and estate planning, portfolio management really is just one piece of a much larger picture. And the piece where the advisor adds probably the least incremental value because the portfolio is mostly or should be mostly indexed running on automation.
Yeah, I think the biggest thing, the highest value work we do is we coordinate everything. And that's really important with technology, making sure your estate planning attorney, your CPA, your insurance broker, your investment, an outside investment buyer are all working on the same map. We do that with technology. We connect them to your information. We make sure a liquidity event, a business sale, a secondary tender, the vesting of large RSU grants gets handled as a complex tax and estate event, not as a portfolio transaction.
Yeah, and most wirehouses don't do this. They will have estate attorneys that are on retainer who can speak to you if you request it. They have a tax team who will review, again, if you ask. But the proactive coordination, the advisor who initiates the conversation because they saw something in your situation before you do, that's rare. But that's really the job.
Yeah. We call our model the portable family office because your assets sit on Fidelity or Schwab, neutral custodians that belong to you. And if you ever want to leave, you remove us from the account and your assets stay exactly where they are. No entangling, no lock-in. That's a deliberate structural choice on our part. So we're not trapping you in a system like, I used to do when we were at Merrill. You were kind of like, if you were unhappy, you had to leave. You had to unravel everything, your banking, your checking, and you don't. You can leave everything at Fidelity or Schwab.
Yeah, and so that's the family office because the service model, it's comprehensive. Investment management, tax planning, estate strategy, insurance audits, banking, coordination, next gen, wealth counseling. And we have one team, one fee, and your full financial life will be organized and stored in the cloud.
Yeah, and all of that for one disclosed fee with no markups, no commissions, no revenue sharing. What you see is what you pay for. When we pick up the phone and call you, there's no motivation to sell you a product.
So let's talk about alternatives because this is where clients we think are overpaying the most and getting the least transparency.
Yeah. So private markets, private equity, private credit, real estate, infrastructure have generally attractive return characteristics, and they're less correlated to public markets. The best managers have delivered consistent long-term returns that justify the liquidity premium. These are real strategies that belong in portfolios of families with the right time horizon and the right capital base.
It's the problem isn't the asset class, it's really the access structure. And for most clients approaching private markets through a wirehouse or traditional advisor, the cost stack looks like this. The advisory fee, you've got 1%, the manager's management fee, 2%, managers carry interest would be 20% of the profits. And then you've got a feeder fund layer that the advisor uses to batch your clients, another 1%. So you got 4%, again, plus carry before you're earning anything.
Yeah, and that structure, a private equity fund that generates like a 12% gross return becomes a 7 or 8% net return to you after all the layers are paid. And you're paid carry on part of that, which is just market beta anyway.
So, this is why you hear us talking more and more about an evergreen structure, which is an open-ended vehicle run by some of the best alternative managers, Blackstone, Ares, KKR, where the management fees typically are around 1.2%. We access them at institutional pricing. Our highest feeder fund fee is 25 basis points. And so the math for the client is dramatically better.
Yeah, and the evergreen structure has another advantage that really matters from a planning perspective. Is it's got liquidity on a quarterly basis. They can gate you. So, we kind of tell clients mentally assume that if there's 10 years in some kind of a deep, dark recession, you're going to get gated. But figure if it's liquid 8 out of 10 years, that's a lot better than 0 out of 10 years for a draw fund.
We do use selectively, we do use draw funds, but we try to really have that where we think there's real differentiation and real alpha potential, and that's where we want to save our fees and our complexity. So, that's more likely early stage venture, maybe small and mid cap buyout where the management selection and access really matter. So a draw fund with conviction and specific manager makes sense, but we would say it's the exception, not the default.
Yeah, one more structural piece that most clients don't know and should.
Yeah, let's talk about the suitability standard and the fiduciary standard, because they sound similar, but they are fundamentally very different.
Yeah. Under the suitability standard, which applies to broker-dealers and wirehouse advisors, the advisors must recommend something that is suitable for your situation. Not just the best thing, not the lowest cost thing, not the thing with no conflicts of interest, just something that isn't obviously wrong.
So it's a relatively low standard compared to the fiduciary standard, which applies to all RIAs and to us, which is the advisor must act in the client's best interest at all times. They must disclose all conflicts of interest and must seek the best available terms for the client. So that's a materially higher bar.
Yeah. And here's the test. Ask your advisor, are you a fiduciary in writing all the time? Some advisors operate under both standards, depending on what type of business you're doing. They're fiduciaries. And when you give advice, broker-dealers, they can also execute transactions. That's called a dual registration. And I think it's a problem. When I was at Merrill, I was dually registered. And so you'd be getting commissions on private equity and you'd be charging an advice fee in the other part of the portfolio. Very confusing for the clients. Very, very confusing to really understand, the motivations of an advisor.
Yeah, here we're a lot simpler. We're a registered investment advisor. We're fiduciaries in writing all the time. And that's not a marketing claim. It's a regulatory designation with legal obligations attached to it.
So let's bring this all together. The wealth management industry was built on three things. Your advisor had access you didn't have, information you couldn't verify, and products you couldn't compare. This is a structurally collapsing. AI is accelerating it, and the families who understand what's happening are in a position to pay dramatically less and get dramatically more.
And this shift is not subtle. I mean, a family paying 3.5% in total cost versus, around or under 1% on a $10 million portfolio, it's leaving $300,000 a year, on the table. And that's not a rounding or, compounding again over 20 years. That's a family legacy.
Yeah, we built a line for this moment, the technology that makes it possible to run a direct index strategy with daily tax harvesting, to access institutional alternatives without a feeder platform fund markups, to coordinate families' entire financial picture, one transparent platform. That tech did not exist 5 years ago. It didn't exist 15 years ago. The old model had no answers for it. It does today.
It does. And so here's what we would say is bring us your statement. We'll show exactly what you're paying all in, including the layers that your current advisor may not have disclosed. We'll show you how our portfolio compares to a best practices benchmark. And if we can improve your situation, we'll tell you exactly how.
Yeah, there's no obligations. There's no sales pitch. It's just the data. If you're watching this video, you know what to look for already. And the numbers will make sense, but to you that we're going to show you. We really appreciate you taking time to listen to us. Please like and subscribe to our videos and give us a call. Pat and Greg, we're available to meet with you. We're available to talk to you. Send us your statements. We'll give them a look.
Thank you.
Thanks so much.